Hi traders, and welcome to the next video in this course on scenario analysis for central banks. So this video and the next one, which will be scenario analysis for economic data, they'll be the last two videos of this section. And what we'll then do in the last section of this course is talk about how to piece all of this information together. So everything we've talked about in this section and in previous ones, how do you start to put all of that together to generate trade ideas and execute those trade ideas? So let's now get into the video. And firstly, I'm just going to give you a guideline for the steps you need to take to prepare for the meeting. So the first step is make sure you go and read the policy statement from the previous meeting. So when these central banks meet, it's usually a two-day meeting that they have. And during this meeting, they'll discuss various things. How is the economy doing? Is it performing in line with their projections? Are their policy settings appropriate? What are they worried about? Where are the risks to the economy? Are there any changes coming up that could impact them? What's happening with the global economy? Is there anything going on with fiscal policy that could impact what they're doing? They'll discuss all of this over 2 days, and then the statement will basically summarize what they've discussed. So the statement is usually about 4 to 5 paragraphs long, and it's firstly just going to summarize the decisions they've made, if they've made changes to the policy settings. They'll talk about their outlook on the economy, areas that they are happy with, areas that they're concerned about. They'll talk about whether they feel like the current monetary policy settings are appropriate or whether they need to change, and what they are expecting to happen over the next few months. So that's the first thing you need to do. Make sure you have that policy statement. And the reason why you need to do this is because remember in one of the previous videos of this section, we talked about relativity. In the markets, everything is relative. It's not just this central bank is hiking, so I'm going to go and buy their currency or I'm going to go and buy their bonds. It's all about relativity. So in the case of central banks, if they go and hike rates, we've talked about how higher rates will strengthen the currency, it will increase demand for those bonds, and generally push equities lower. But if they've already said at the previous meeting that our plan and we expect to be hiking rates in the next couple of months, then the markets are forward looking. So they've already started to price that in. So then if you get to the current meeting and the central bank hikes rates, the markets might not move at all because it's priced in. It's all relative. How much has this statement changed relative to the previous one? And if they've hiked rates, but there's not really any other surprise, then compared to the previous one, nothing's really changed. So there's not really a trade there for you to take. And there's not really a lot of movement for the markets to make either. So that's the first thing you need to keep in mind. The second thing is make sure you have a copy of the latest set of economic projections from the central bank. So the central bank will release their economic projections. So basically, what do they think the unemployment rate is going to be over the next couple of quarters and the next couple of years? What do they think inflation is going to look like? What about GDP? Those key macroeconomic indicators, they'll have projections for them. And these projections are normally released every 3 months. So it may be the case that when you go to look at the previous policy statement, there weren't any projections released at that time. So then you've got to go back to the meeting before that and see were the projections released during that meeting. So figure out which ones are the latest set and make sure you have a copy of them. Now, This document with the projections typically is going to be around anywhere between 11 to about 30 pages long. It'll have a lot of detail in it. If you have time to read it, it's worthwhile going to it, because the central bank will outline in detail what they are looking at, and basically explain how they came to the projections that they came to. What are the reasons for it? If you don't have time to do that, as most of us probably wouldn't, then that's fine. Just make sure you've got the projections, and make sure you can find a lot of articles online where they generally summarize what's been said in the policy, in that policy statement, or in that policy report with the projections. You then want to have a read through the minutes of the last meeting. So the minutes are different from the policy statement. The policy statement summarizes what they discussed, whereas the minutes will go through the last meeting in a bit more detail and outline what different central bank members said in response to different things that they discussed. And sometimes the minutes can just give us a little bit more detail about what certain central bank members are looking at, or what they might be worried about. So it just adds a bit more color to the policy statement. Now, the minutes are usually released during later in the week after the meeting, or sometimes around 2 weeks after the meeting has already taken place. So this will normally be outlined on the economic calendar, and it varies for different central banks, but you just want to make sure you've read through the minutes of the last meeting. Then you want to assess the data that's been released since the last meeting, especially the data where the data that indicates what's going on with the areas of the economy that the central bank are most concerned about, or most focused on. So if they are looking at, let's say, the labor market, and they are worried about weakness in the labor market, that means that we need to watch the jobs data very closely. It means that the jobs data is likely to be market moving. So that's where a potential trade could be generated from. We then want to assess the market expectations for the upcoming meeting. Again, everything is relative. So if there's a change in the during the upcoming meeting in their policy statement or with the policy settings, but the markets have already anticipated that and priced it in, then that change is probably not going to result in much movement. So you want to be aware of what the markets are already thinking, and what sort of things have they already priced in. You want to also look at if there's going to be a press conference. A lot of central bank meetings will have a press conference that follows. Now, someone like the Federal Reserve, the central bank for the United States, a few years ago, they used to have a press conference, I think it was at every other meeting. And then in the last couple of years, they've changed it to having a press conference at every single meeting. So some central banks will have a press conference after every meeting, and it's usually around 30 minutes or so after the policy statement has been released. Sometimes it will be every other meeting, or maybe even less frequently than that. So you just want to go and check whether there will be a press conference or not. The reason you want to do this is because if there is anything in the policy statement that you think is worth trading, you need to keep in mind that if there's a press conference, what if the governor says something that then changes the market's interpretation of what they initially thought when they read the policy statement? That would then impact the markets. Or what if they talk about something that hasn't been mentioned yet in the policy statement? Because in the press conference, that gives the opportunity to news reporters to ask questions. So anything that the central bank hasn't addressed, they could be asked about it in the press conference, and then they will be forced to address it in some manner. They might not go into too much detail, but then they are forced to address it in some way. So that's why the press conference can be fairly important. And then finally, once you've done all of your preparation, you want to decide that if there is a tradable opportunity, which assets are you going to trade? And this is the reason why preparation is so key when you have these types of events. Sometimes you get situations where a headline is released. You don't really have time to prepare for that. You've just got to react. But central bank meetings and economic data, you've got time to prepare. And if you prepare properly, it's going to help you, more than taking the correct trades, it's going to help you to avoid unnecessary trades. Because what tends to happen with a central bank meeting is, because it's such a big event and a lot of people are watching it, when the policy statement comes out, we live in a trading environment where there's a lot of algorithms. Around 75 to 80% of trading is done through algorithms in the markets. And these algos are basically programmed to look for keywords or key phrases in the policy statement and react to those. So, for example, if the markets are talking about a central bank potentially hiking rates, the algo might be programmed to go and look at if there's anything that talks about rate increases. Any phrases related to rate increases, and if it's there, go and buy the US dollar or whatever currency. So the algos react then very quickly to the policy statement. And what then happens is that you as a trader, you're still reading the statement, or you're still just going through some of the key headlines. You see that market movement and you panic. You're like, I'm missing out on a trade here. I need to get in. You click the button, you get in, you go long. And then half an hour later, the whole move pairs back. It goes against you and you're sitting there with the loss and you're like, I don't understand what's happened here. The markets were going up. I sort of followed them. What's changed? What's changed is that the algos are not humans. So the institutional human traders, the professional human traders, they've then read through the statement and said, this doesn't warrant a trade, or this move has been exaggerated. So we're now going to fade the move. And that's where you can get caught out. What you should have probably done in that situation is not traded at all. Or sometimes you should have actually traded in the opposite direction. And if you've done your preparation, then you know when to sit out. Or if you think under these circumstances you should actually be selling and the market's actually started buying, that's just going to give you a better price to go short. So this is the importance of doing this scenario analysis. And when it comes to central banks, usually the way your scenario analysis will go is, if you think of a tree, you're basically going to have, you've got the central bank meeting and you're going to have usually three scenarios that play out. The central bank doesn't really change anything. They turn more hawkish or they turn more dovish. Remember, everything's relative. So you want to look at, you want to imagine you're looking at sort of a slider where you've got dovish on the left side, hawkish on the right side, and then neutral in the middle. And you want to assess from the last meeting where were the central bank at that point, and how much has that slider moved at the current meeting. So in your scenario analysis, you're saying that, okay, if that slider moves more to the hawkish side, here's what I'm going to do. If it remains on the neutral side, if there's not really much change, this is what I'm going to do. And if it moves to the dovish side, this is what I'm going to do. And then quite often, out of those three branches, each one will have another two. So for example, if they've gone dovish, are they signaling rate cuts, or are they just indicating some concerns they have about the economy? Or if they've cut rates, are they indicating more rate cuts, or are they indicating that they're not going to do anything more? If it's neutral, are they indicating that they're going to make any changes in the coming months? If they're hawkish, are they indicating that they're going to do further hikes, or they're going to start hiking rates, or are they not really planning to do much? So you have those various scenarios, and then you say that, okay, if this happens, then there'll be two or three scenarios where you say, if this or this happens, no trading, stay flat. If then the other scenarios you have left, if this happens, I'm going to trade, I don't know, maybe euro dollar, dollar yen, the Nasdaq 100, and some other asset. If this scenario plays out, then I'm going to trade the Kiwi against the dollar, the Aussie against the dollar, and maybe gold. whatever it might be. But that's the whole point of your scenario analysis. Under the different situations, what are you going to do? So that's how you prepare for a central bank meeting. Now, what I'm going to also do is we'll now go through an example of a Bank of Canada meeting that we had back in 2019 and 2020, and a potential trade that could have come out of that. Now, we're not going to go through every single step here because that's just going to make the video a lot longer than it needs to be. But we'll go through the main steps, and I'll then explain some of the steps that we've skipped out. I'll just explain why. So I'm going to bring up the policy statement for the Bank of Canada from their meeting on 4th of December 2019. Now, what I'm going to do first is what I want all of you to do is pause the video here. Read through these 3 paragraphs that you can see on your screen. And then after 5 seconds, I'll scroll it down so that you can see the final few sentences as well. And I want you to read through that. And then we're going to move to the next page where I've highlighted the key things in this statement. What I want you to do is go through this and highlight yourselves. What do you think are the key points in this statement? So pause the video here and do that now. Okay, so that's the first part of the statement. Now, the next part is here. Not a lot to read. Again, pause it, read it, highlight what you think the most important parts are. Okay, so you should have done that by now. And what we're going to do is move over to this document here, which is the same one. The only thing is I've highlighted the key parts here. So I'm just going to go through the key parts to keep this video relatively short. We're just going to cover the key points to take away from this policy statement. So firstly, the central bank says they maintained their rates. They've not made any changes there. They then say their October projection, so this relates to their economic projections back in October. This is the meeting for December. This relates to the projections they made back in October, but it's not been updated since then. So remember, we want the latest set. The latest set is October. And we'll look at the projections in a moment. So the projections appear to be intact. So what that means is the projections they made in October and the data that they've had for the economy since then, it appears to be evolving broadly in line with those projections. They then say that growth still expected to edge higher over the next couple of years. They then talk about some of the concerns they have with the economy. So there's ongoing trade conflicts and related uncertainty are still weighing on global economic activity and remain the biggest source of risk to the outlook. Now, to put a bit more color on this, in 2019, at the time we had this statement, we also had the trade war going on between the United States and China. And that was proving to be a global risk because you were looking at 2 of the biggest economies in the world in an economic war with one another. So it meant that the prices of a lot of things were going up, and that was then impacting other countries like Canada. Also, Canada is located right next to America. So they do a lot of trade with the United States, and that means that they were impacted maybe a little bit more than other countries that could have been slightly less impacted by that trade war. Now, some other key points here. Consumer spending expanded moderately, underpinned by stronger wage growth. Housing investment was also a source of strength. So right here, they tell you about 3 areas of the economy that they are fairly happy with. And it's worth just keeping an eye on those. Consumer spending, so that would be something like retail sales, which is the strength there is coming from wage growth. So wages are something to look out for. And then housing investment, so housing data is worth looking at. They then say, however, investment spending unexpectedly showed strong growth. So again, investment spending, something to watch out for. The bank will be assessing the extent to which this points to renewed momentum in investment. So here they quite explicitly tell you they are watching investment spending to see whether this is sort of a one-off reading, one-off green shoot in the data, or whether it's more of an upwards trend. Then the final few points, inflation will increase temporarily in the coming months. So that's important because it tells you inflation, they are expecting inflation to go up, but they also say it's temporary. So it shouldn't really concern them. And if you see that in the economic data, it probably doesn't warrant a trade, even if it moves above their target rate. Then Governing Council judges it appropriate to maintain the current level of the overnight rate target. So remember I said they're going to say what they think about the current policy saying. So at the moment they're saying it's appropriate to leave it as it is. Then they'll continue to assess the adverse impact of trade conflicts against the sources of resilience. So those sources of resilience, we went through those here. The main risk is that trade conflict. And then they've again reiterated, notably, consumer spending and housing activity. So that's the previous policy statement. We've now highlighted the key things that the central bank were looking out for, and we know what data we need to look at. Now, in reality, when you do this on an ongoing basis, it will be in the back of your mind what was discussed, and you need to know this before the next central bank meeting comes up, because you need to know what economic data to focus on as well. But if for some reason you've missed out on the data, or you haven't quite been focusing on that central bank, which happens sometimes because there are central banks where they go through long periods of doing nothing, so you sort of stop really paying attention to their data and their central bank meetings because it's often uneventful and you don't get any trades out of it. But then all of a sudden, if something changes and you need to catch up with what that central bank are doing, then these are the steps you've got to follow. So this is the December meeting. Now, what we're sort of imagining here is we're preparing for the meeting happening in January 2020. So we're preparing for the January meeting, which means we need to go back to the previous meeting in December and read through that statement. So that's the first thing we had to do. Now, have a copy of the latest set of economic projections. So I've now taken a screenshot out of the monetary policy report from the October meeting that the Bank of Canada had, which was the latest set of projections. And we can see those here. So CPI inflation for Q1 2019, which has already passed, it's showing you the data they already had. Now, there might be some slight adjustments to it because as you get more data throughout the year, some of these numbers, even though that period has passed, the numbers can be slightly adjusted. And the easiest way to explain why this happens is, the example I always use is, imagine a company that's selling some sort of product. It could be pencils. Now, if you're a private company, you don't need to give your sales data or your gross revenue or anything like that. You don't need to provide it until you file your accounts, which is once a year. And usually you're given a few months after your company year end to file those accounts. So, for example, in the UK, you have 9 months to do it. So if your year end is in January, you don't need to provide your company statement until you get to September. So it won't be until September that other people get to find out what was your revenue, what were your sales numbers. If you're a publicly listed company, you've got to do this on a quarterly basis. But we get a lot of data like retail sales spending once a month. And the way that they get this data is by sending surveys to a lot of companies and asking the companies to basically give an estimate of how much they've sold. And this data then gets compiled, and it's not going to be every single company in the country. So it gets compiled together and it provides us with an estimate for what's happening across the entire country. Which is why, even though the period has passed, as you get more data later in the year, as you get earnings for publicly traded companies, as other companies publish or do the accounts for their companies, you start to get more data, and that can slightly cause an adjustment in these readings here. So this is what has happened with inflation. And then you can see that we're in December, so Q4, that's the quarter we would currently be in when the central bank had that meeting. And then these are the projections for 2018-19 and then upcoming 2020 and 2021. And the numbers in the brackets show how the projections have changed from the previous projections. So in this case, these projections were in October, so the previous ones would have probably been in July. Then you got the same thing for real GDP. So you can see GDP is expected to be fairly stable over the next few months. As the central bank mentioned, slight growth expected, which we can see from Q3 to Q4, and even from if you go from 2019 to 2021, a slight pickup is expected. So those are the two main readings you have here. Other central banks might give you a couple more other pieces of information, like the unemployment rate, for example. But with Canada, we've just got these two, so that's fine. We've got the projections, we've taken a look at them. Then read through the minutes of the last meeting. Now, as I said, the minutes can be fairly lengthy, so I'm not going to go through those, but in this case, we didn't get anything from the minutes which provided us with any different information from what was already in the policy statement. Sometimes the minutes are uneventful, sometimes they can give you a little bit more information. So in this case, we didn't really have anything in the minutes. And again, like I said with the monetary policy report, if you have time, go through the minutes. If not, a lot of the other banks and analysts out there, they'll usually produce articles which summarize the main points that came out of these minutes, so you can just go and read through those. Then we need to assess the data that's been released since the last meeting. So let's do that over the next few slides. So firstly, we had some labour market data and housing data for the Canadian economy. So with the employment data, we came in weaker than expected. We lost a lot of jobs in November. And the jobs lost were split quite equally between full-time and part-time employment. The participation rate also dropped off a little bit, and the unemployment rate rose to 5.9%. So a pretty weak report. And remember, the central bank said they were pretty happy with wage growth. If the labour market's not doing well, wage growth is probably not going to do that well. Then we had housing starts. A slight miss there, but it's only by 4,000, so it's not a major miss. So don't just get caught out because these are highlighted in red. Also look at it relative to the previous number. That word relative is going to be so important in trading. Building permits, they came in a little bit weak. They came in at minus 1.5. So not really great data there. After that, we had this announcement, this headline, this news report. China and the US reach a phase 1 trade deal that includes some tariff relief and agriculture purchases. So remember I said that main source of uncertainty and that main risk was from this trade war. Now, a few days after the meeting, we got this headline that the two sides had reached an agreement to basically hold off on that trade war, or ease the trade war a little bit. And the tariff relief here was key because it was the tariffs which was impacting both those economies and other economies in the world. So the tariff relief would help to ease some of that pain. So this was quite a positive because it takes away or it massively reduces one of the main risks that the central bank is worried about. Then moving on, we had some CPI data. So here, the CPI numbers we had for the common number, which is one of the core readings, stayed the same as previously. Another one of the core readings, month on month, came in at minus 0.2%, so a little bit negative. The central bank said they are expecting inflation to edge a little bit higher. Now, given that they are pretty much around their target, it's not a major concern. The headline number 2.2%, which is as expected. Headline month on month, minus 0.1%, again as expected. The median and the trimmed, so the median came in higher than expected, and the trimmed also slightly higher. Now, the way that the Bank of Canada likes to look at core inflation is by taking an average of the common, the median, and the trimmed CPI. So in this case, because this remained the same, and these two edged higher, the average would move a little bit higher. So inflation, core inflation, has gone a little bit up, and it's very much sitting around their target. And again, the central bank did say that we expect inflation to temporarily go higher. So this is not concerning. It shouldn't really change anything for the central bank. Then some more data. We had the new housing price index, which came in as expected, so a slight increase in prices. Retail sales were pretty weak. So retail sales came in at minus 1.2 and core retail sales minus 0.5. So consumer spending, another source of strength, started to weaken a little bit. Then we get to the housing starts data. This is in January now. So we get to housing starts. We came in at 197.3k. It's a bit of a miss on expectations again, but it's not a massive miss. So not too concerning. And building permits have again fallen. So that's maybe a little concerning. We had some more jobs data. Employment change came in at 35.2k, better than expected. And that recovers about half of the jobs that were lost in the previous month or the previous report. And most of these jobs were added in full-time employment. So if you look here, all the jobs that were lost in full-time employment have pretty much been recovered. Part-time employment, yes, it's still a little bit weak, but full-time employment is usually the main number to focus on. Participation rate, that has come in a little bit lower than previously and a little bit lower than expected. So that might be a bit of a concern. The unemployment rate, that's come in better than expected. Previously, we were at 5.9, so we've improved a fair bit there. And then we have some more inflation data. So again, common CPI this time edged a little bit higher. The headline numbers year on year stayed the same. Month on month dropped off slightly. Median slightly dropped off there as well. The trimmed slightly dropped off there. So basically, almost the upside we'd seen in the previous report, we saw a reversal of that. Again, it's not a big deal. The inflation numbers are still around the central bank's target, so they shouldn't be worried about that. The new housing price index, that came in a little bit higher than expected, so house prices are going up. So that's the main data that we had for Canada between their last meeting and the upcoming one. So now let's go back to our steps for preparing for the meeting. So we've looked at the data. We now need to assess the market expectations. So the market expectations here were, okay, consumer spending, which was a source of strength, that's weakened a little bit. Housing still remains pretty strong. House prices have gone up. So even though building permits came off, the prices were still pretty strong. The labor market, yes, the first report wasn't great, but if you're looking at full-time employment, most of those jobs were recovered. So again, it's not a massive drop-off. And investment overall has remained fairly resilient. The biggest risk the trade conflict has been quite massively resolved. So then heading into the next meeting, the expectations were that, okay, some data has weakened, but the biggest source of risk has gone away. So even though things aren't exactly all nice and rosy, they aren't terrible either. And the central bank should remain around the same should remain with the same sort of tone. Remember that slider we talked about, dovish to hawkish? The last meeting, you could say that they were maybe very, very slightly into dovish territory, just one step below neutral. And you could say that given the information we have, they're probably going to remain at that level. The trade deal news is positive, but we probably want to see that some of that spilling over and impacting the economic data in a positive way before we move that slider a little bit higher. So we're not really expecting any change for the central bank at this meeting. Now, when we got to the next meeting, let's bring up those statements again. So this is 22nd of January 2020. Once again, pause the video here, go through this statement, highlight the key points. So I'll give you 5 seconds. You can pause the video, take your time, and then I'll scroll down and show the last paragraph. Okay, so let's go a little bit lower, and you've got a few more sentences to just read through here, so I'll keep it here. Again, pause, read through it, highlight the key parts. Okay, so you've now read through the report, and again, what I want you to do is pause here for a moment and just think about how different is this from the previous statement. Where would you now put the slider? Is it going more to the dovish side? Is it going up to more towards neutral? Or is it going maybe further to the hawkish side? Or is it the same? So have a think about that. And let's now move on to the next statement, which is, again, it's the same statement, but I've just highlighted the key parts. So once again, they've maintained their target rate. That's not changed. Now I'm just going to zoom in a little bit here. And what we can see is the next part is some recent trade developments have been positive. That relates to the headline we talked about. There remains a high degree of uncertainty, and geopolitical tensions have re-emerged with tragic consequences. That's not really a great line. It's a pretty dovish line to put in there, despite that trade deal agreement we saw. Then the data indicates that growth in the near term will be weaker. Remember, previously they were saying that they expect growth to edge a little bit higher over the next few years. But now they're saying in the near term it's going to be a little bit weaker. The output gap wider and wider than what they had projected in their October forecasts. They then talk about some of the projections here, because I think at this meeting they had updated and released some more projections. Business investment appears to have weakened. So from the data we saw, investment still looked fairly decent. They're saying it's weakened. Sometimes the central banks, even though we can see most of the data that they see, they do put out surveys and questions to businesses. So sometimes they do get a bit of an inside look that we won't see. So that's where this seems to have come from. Job creation has slowed. And indicators of consumer confidence and spending have been unexpectedly soft. So we saw that with the labour market data and the retail sales. Then during the past year, Canadians have been saving a larger share of their income. So if they're saving more, they're not spending, which could signal increased consumer caution. The bank is also projecting a pickup in household spending. So It might have slowed at the moment, but they are expecting it to pick up. And then in determining the future path for the bank's policy rate, Governing Council will be watching closely to see if the recent slowdown in growth is more persistent than forecast. Now, this is probably the most important line here, because if I go back to the last statement, that same paragraph, Governing Council judges it appropriate, right? You come to this one, and they'll be watching closely that they've now dropped that line, that they're not saying it's appropriate anymore. They're watching closely to see if the recent slowdown in growth is more persistent than forecast. And they'll pay particular attention to developments in consumer spending, housing, and business investment, the same as previously. So you now know what you need to look out for the next meeting that comes up. But given that they are now saying, they're basically saying the current policy stance is not appropriate, and the general language here is negative, and definitely more negative compared to the previous statement. I'm not saying it's like 100% more negative, but it's definitely increased. So that now indicates that there's a slightly higher risk for them to cut rates. So if we now go back to our slides here, we can ignore the press conference and the deciding which assets now. What we're going to do is look at the charts. And what we'll see is that we had the first Bank of Canada meeting here, the trade deal announced here. Now, that first Bank of Canada meeting, this is a chart of the US dollar against the Canadian dollar. So that first meeting they had, where they were pretty neutral, we saw a bit of strength in the Canadian dollar, and then when we saw the trade deal, that strength continued. But when we then got to the second meeting here, remember, what did we say when we went through the data? We said, okay, some things have weakened, but housing's not too bad, and there's that trade deal, which they stated was the biggest risk, that's been massively reduced. So our expectations was that they would remain about at the same level on that slider, and the market expectations were roughly in line with that, exactly as what we said. The Bank of Canada came in with this statement, more dovish than expected. So that slider from where we were expecting it to be and where it was previously, it moved lower, and that was not expected, so it wasn't priced in. And as a result, what happened here? The markets, the Canadian dollar started to weaken. So the US dollar Canadian dollar pair moved higher. And you can see that was fairly consistent for about 2 weeks. So now if we go back to our steps. So in this case, a press conference, I don't quite remember if there was a press conference after this meeting, but you do need to check that and keep an eye on it if there is one. In terms of deciding what assets you will trade, so our base case, what we thought would happen is that there wouldn't be any change. If there wasn't any change, and it's not changing from previously, if there's not going to be any change at this meeting, we should sit out. There's no reason for us to be in a trade. Now, if unexpectedly the Bank of Canada got a little bit more hawkish because of that trade deal, then maybe there was a reason to go long on the Canadian dollar. So we would have then looked at the markets and said, okay, if we're doing FX trading, what pairs are best to go long? So if you want to choose what pairs are best to go long, you're going to have a reason to go long Canadian dollar, which is going to be the central bank meeting, but you need a reason to go short on the other pair or on the other currency. So for example, if you do US dollar Canadian dollar, you need a reason to be short on the US dollar. If you do Canadian dollar against the Japanese yen, you need a reason to be short on the Japanese yen. So you pick your pairs according to that. So let's say that we said, okay, we're going to go long Canadian dollar, and we'll pick maybe, let's just say for the sake of for this example, we'll say the pound, because the Bank of England are maybe looking to cut rates. And we'll look at the euro because the ECB are pretty dovish. So those are our pairs. And then you might have said if you're doing bonds and if you're doing Canadian equities, you might have chosen those as well. For now, let's just stick to FX. That's if they go hawkish. On the other hand, if because of the data they turn more dovish, what are we going to trade? So you could say, okay, well, we've just had the trade deal, which is positive for the US economy, as it is for a lot of other economies. But if the Bank of Canada go dovish, then US dollar, Canadian dollar would be a good pair. You might say that the Canadian dollar, the Aussie dollar could be a good pair against Canadian dollar because the Aussie dollar, the Australian economy do a lot of trade with China, so they would benefit from the trade deal. And if we want to sell the Canadian dollar, the Aussie dollar might be a good one to be long against. Another thing you've got there, we'll talk a little bit more about this in the next section, but one of the advantages you have with that, with US dollar, Canadian dollar, and Aussie Canadian dollar, is the US dollar is a safe haven. The Aussie dollar is what we call a high beta currency. And you're firstly pairing it against another high beta currency. So that neutralizes some of the risk exposure you've got. Because if there's positive or negative risk sentiment, there should be limited impact on that pair, since both currencies will be impacted by that change in risk sentiment. But if the Aussie dollar was to be impacted more than the Canadian dollar, then what you've also got is you're long on the US dollar, which is a safe haven. So the negative impact on the Aussie dollar could be cancelled out by the positive impact on the US dollar. And that's an additional reason for why those pairs could work quite well. But as I said, that's something we'll talk about a little bit more in the next section. So you've now picked your two pairs that you're going to go, you're going to short US dollar, Canadian dollar, and Aussie Canadian dollar. So those are the assets you're going to trade. We then got to the meeting. It was more dovish than expected. That slider moved down. So you execute those trades. And they would have done fairly well. So that's basically how you prepare for a central bank meeting. But what I will emphasize, like I've said right at the start of this course, is this course is only going to lay the foundation. What we've done here, that's not going to work out so cleanly every single time. Like we said with technical analysis, when you look on the internet, you'll see all these patterns that play out so cleanly and seems like it's so easy to do it. In reality, it's not that easy. It does require a lot more work. Conditions are going to be changing all the time. So there's so many factors you've got to consider as well. As I'm recording this, you've got central banks around the world doing a lot of rate hikes. Some of those currencies are not moving at all because of relativity. Loads of central banks are doing the same thing. So why will one currency strengthen more than another? So the conditions always change in the markets, and you've got to adapt to them. And that's why no one will be able to provide you with a foolproof blueprint on how to trade the markets. It's never going to happen. Even the algorithms, as I said earlier, 80% of trading is done through algorithms. And they're going to lose out at times as well because losses are simply a part of this game. And if you want to survive in this industry for a long period of time, then the key thing is that you'll always have to keep learning and you'll have to be able to adapt to the market conditions. So this is your rough guideline for how to prepare for a central bank meeting. You should probably print this out or write it out and keep it somewhere with you. But depending on the situation, there might be additional things that you need to look at. There might be things that you can sort of strip off here. For example, if there's no press conference, it doesn't matter. It might be that there's something happening on the geopolitical front, which is more important. That you need to keep a close eye on. So just remember, you'll need to adapt this every time for different central banks, but this is the broad outline of how you go about approaching a central bank meeting. So that now brings us to the end of this video. Thank you for watching and see you again in the next video. Cheers.